I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday, October 23rd, and I'm delighted to be joined here by Luba Nikulina, a longtime friend of mine and head of strategy, global head of strategy for IFM Investors. And she has a broad perspective across many asset classes. So, really interested to hear her take. Welcome, Luba. Thanks for joining us here today.
Fantastic to be here. Thank you for inviting me, Ethan.
Well, as usual, I'll pull up the slides and we'll kick this off today. I have called today's podcast Data Lakes and Data Deserts, as we have a little bit of a discussion later on about the state of affairs in private credit. And one of the observations there was that there was actually quite a shortage of data in the private credit space about who's paying on time and how creditworthy are some of the issuers. And I just thought that was an interesting comment to compare with what we're thinking about in terms of us being awash in data with AI. So just a little bit of a play on words there. As usual, we speak about inflation, geopolitics, interest rates, equity markets, and other asset classes. And we'll have a little bit of a discussion on gold today, as obviously we've seen a bit of a change of direction for gold just in the past week. We are going to look at inflation being a little softer, which is good news for most economies around the world. Ask how bonds have reflected rate cuts. We'll see how tariffs are continuing to weigh on equities, particularly when the rhetoric gets more intense. And as I mentioned, we'll speak about tarnished gold. So here's Luba, IFM Investors Chief Strategy Officer, responsible for leading the development of the global strategy of the firm with a focus on private market solutions. So great, Luba. We'd love to hear your thoughts when we speak about asset allocation and the solutions. So let's just jump straight into inflation. So one of the slides I showed last week was the fact that oil prices were down to their lowest level in nearly 5 years. There's also a sense that expectations around inflation, particularly in Western markets, are low and lower than they've been for 20 years. We know that because thanks to oil, the price of gas at the pump will be down. Now there's a focus on food and wondering how much food prices will in fact be subdued. But it does seem that at least even the UK is seeing stability at 3.8%. It seems that inflation is coming down. You must spend a lot of time speaking with your clients about inflation and inflation resilience. What is your take as a firm level in terms of the whether we have inflation tamed at this stage?
Yeah, thank you, Ethan. I just remembered the last time we spoke on podcast, which was a few years ago, and we were talking about the need for orthogonal thinking. I think nowadays this thinking is even more required than it was a few years ago when we connected last in a podcast. This is how you need to treat all this data that is coming through. So, for example, oil prices, which we see in front of us. Yesterday, with the sanctions from the US on Rosneft and Lukoil, all of a sudden there is a spike in prices. So this whole system of how various macro themes are feeding into the stability of the economic system has become much more complex and much more fragile. So you have this, I would call them tectonic shifts working their way through the system. Completely different macroeconomic policy compared to how it was before COVID. You have technological advancement with AI. You have fiscal stimulus. So there are lots of forces there that make it really difficult to predict what is going to happen with the economy or with inflation in particular. But all that said, the conversations that we have with clients, we would probably be saying that the market is somewhat complacent right now in how it prices potential risks of inflation. There are obviously some disinflationary forces feeding in, such as potential for AI, for example, the productivity that still keeps going strongly. But then the number of forces that are feeding through the system that are inflationary I would argue, much more powerful and arguably underpriced. So be it fiscal stimulus, be it immigration policies, be it the capex that are flowing through the system on technology, of course, tariffs, reconfiguration of supply chain. So I can carry on and on. But the key takeaway here for me would be that despite the volatility and potentially some softer signals in the last week, I would still argue that risks are skewed towards higher inflation.
That's absolutely fascinating. I think a warning against complacency I'm hearing there. And I have presented the UK picture here. We're both sitting in the UK today. I think it's an interesting example of complacency. When we have inflation print coming out for September at 3.8% again, it's stable, it's high, much higher than I think the consumer can sustain over the long term. That's considered a positive sign and considered stability. So we've already kind of normalized this higher level. And then when we look at the drivers of inflation, it's cited here as being butter, milk, beef, veal, chocolate, and coffee. Some of them more staples than others. Certainly, some of them are staples for me. But I would think that some of this is related also, ostensibly in the Financial Times, to climate change and to some of these factors that are affecting the price of food. And I think it is important to mention these food and oil price because they really affect the lower income consumer most of all, perhaps that they for them are not discretionary items. So there's I think perhaps this warning against complacency is a good one. How do you then work with clients to factor this resilience around inflation into portfolios? Do you think that the traditional asset classes are still sufficiently participating in inflation like that?
Mm. Well, the challenge with inflation as a concept is that it is really hard to predict. It's this multi-layered concept that just works its way through the system. But similarly, for asset allocators, it's really hard to protect themselves against inflation. So our argument would be that diversification would allow you to increase the resilience of portfolios. So this is something that we are arguing for, especially in the current context where there is genuine vulnerability there in concentration of portfolios, be it the US dollar, US equities, the technology companies within the US equities. So talking about diversification through various asset classes is already a benefit. But then considering the main area of activity for IFM, which is infrastructure investing, I find myself often speaking about the benefits that infrastructure, especially core infrastructure, could bring to the portfolios, because these are assets where the link to inflation is more direct than you could find in any other asset classes that traditionally are known as protection for inflation. So, for example, toll roads or utilities, they would often have direct escalation to inflation. So that is really helpful for clients. And I see it in the market that there is so much interest from institutional investors in core infrastructure. So it's the signal that despite this level of complacency exhibited in the current pricing of different assets, there is still the realization and certain level of constructive anxiety in the institutional investor community. So the desire to find something that would allow to preserve the purchasing capacity of assets that they hold.
It's really interesting. Again, thank you for that you mentioned the multi-layered aspect of inflation, because I see that it is permeating the attitude to all asset classes today. Certainly gold, and we'll talk about that later. But equally, when inflation, we know, is kind of the drumbeat is still there, even if the headline seems to be down, it affects the desirability of holding fixed income. It also I think is factoring into not only to just equity market returns more broadly and particularly tariffs. So I think it is driving a risk appetite, knowing that there's a need to generate returns net of inflation. And then we move generally from inflation to bonds, since it is ostensibly the inflation rate which drives the monetary policy. And we can see that it seems to be overall pretty much in sync in terms of a belief of the next wave being down in the US. Even in the UK now, we've seen borrowing costs fall in a bit of a boost for the Chancellor, as there seems to be a bit more rhetoric around tougher spending cuts, some tax increases, and a bit more robust economy emerging. I would think that this is, as well, we've got a liquidity page about liquidity being quite high. I would think that lower rates bode well for the infrastructure space, given that many of the business models are based on interest rates. Is that your observation?
Yeah, well, definitely for financing, but then at the same time, as we were discussing, the I wouldn't be allocating to infrastructure based on the outlook on the rates, because frankly, it can go either way. At the moment, the expectation is that they may go down, but then at the same time, if we are right about the inflation spike, then the government will end up in the situation, well, the central banks essentially will end up in the situation where move downwards would become questionable. And so this strong linkage with inflation is where the core benefit of the asset class lies. But with bonds in particular, so it's sort of like we are looking at the moment at relatively short-term changes in yields. I think in my mind, when I look at the overall landscape, what is worrying is that the public debt is at the level that we haven't seen since World War II. And if we look at the outlook, even with what is currently happening in the UK and the desire to balance spending and revenues, there is still the increase in overall fiscal spending going forward. And this is, it's a kind of situation we were talking about, the orthogonal thinking and systems. It's kind of situation where the system is in equilibrium for a while there is confidence in the system, and then there is an event that just takes it out of equilibrium, and then the system jumps. And so the situation with the public debt and yield on government securities is exactly at this stage where we already had a taste of the Liz Truss moment in the UK, and now we've been testing the same limits recently on the yield. And then I would argue in the US, which is like very significant for the global economy, after the Liberation Day, there was a similar kind of situation where the treasury yield started testing the limits of what is possible, and actually the markets started influencing the decisions of politicians, including to the degree where we had the government crisis in the UK around the Liz Truss moment. So it's sort of, it feels, despite the softening here, it does feel relatively fragile, just considering the levels of debt that we are right now, and also the continuous desire to continue spending, be it through stimulus or defense spending or other policies.
Absolutely. And I do think there's quite I'd say a heightened scouring of the universe for that trigger, for that episode that might cause the system not to hold. And in a way, because everything is so interconnected, it's kind of impossible to do it for not proper scenario analysis as to how that's likely to emerge.
Yeah.
And my next topic was moving on to review something we'd seen last week, and that we've more mention of cockroaches than I think I ever want to see in a lifetime in terms of Jamie Dimon's famous warning sign. But now we've seen a lot of more commentators, including the Bank of England Governor Andrew Bailey, getting on this bandwagon of sounding alarm bells around private credit. And back to this data lake and versus data desert that I cited earlier, it seems we're still really grappling with very little information. in the private credit. We've seen two high-profile bankruptcies. We've seen two regional banks encounter trouble again in the US, and we've seen suggestion that it's not just one. There'll be more kind of fallout from this. But from what you see, have you seen any indication of any perhaps kind of something more concerning in private credit? Do you see that there's any concern by investors, perhaps, that it's got too crowded, too opaque, too aggressive?
Yeah, well, the emergence of cockroach references is definitely never a good sign because it's a significant signal to the market, especially when it comes from the likes of Jamie Dimon or Bank of England. Another one which happened last week was IMF, so also sounding the signs of concern and potential sharp corrections. Now, when I look at the overall state of private debt market, the growth was obviously very quick. There was a lot of demand from institutional investors to get this additional yield from illiquidity. But then, as you say, if the data is less readily available, and there may be some practices sitting beneath the top level of just providing private loans to companies that could potentially have a trigger effect, similar to how gilts and spike in yields in the UK in 2022 all of a sudden led to the LDI crisis. So you could potentially see something like that. All that said, I would mention the following, that the whole expansion of private debt was happening as banks were stepping out of providing certain types of financing. So they were deleveraging. And then also private equity sponsors, they are now much less inclined to use leveraged loans, and they tend to prefer the private debt direct lending providers. Which essentially just balances each other out. So there is less indebtedness in the banking sector, and then you have private debt providers stepping in. They tend to be not leveraged themselves, unlike banks. So it's sort of like another buffer on the system. And then also we are talking about all this expansion of private debt in the context of public indebtedness shooting through the roof. But then at the same time, if you look at the private sector businesses, they actually have fairly healthy balance sheets. And so the level of leverage in the private sector is not as significant as it was, for example, during the GFC. And so it gives you a certain level of resilience. And when I try to interpret why the cockroaches references all of a sudden, I do come back to this instability of the system, because it feels like it is fairly balanced at the moment, but it only takes one potentially significant event and it can go off balance, and then the knock-on effect will just take the system out of equilibrium, and then it could lead to many more cockroaches.
Oh no, fascinating analysis. And I think also there's a bit of muscle memory at work. There's a bit of maybe sloppy due diligence, rushing to a conclusion. That definitely there is a bit of muscle memory from '08, and when some due diligence wasn't quite right. We still have this regional bank kind of alarm from time to time that was put out the last time, but it could be the source of another similar crack. And then at the same time, we have elaborate, sophisticated financial engineering on the AI side of things. Cash-rich companies, solid balance sheets, as you said, but quite a lot of whether it's vendor financing or just elaborate interconnectedness emerging, which is starting to look like some of those multi-layered derivative instruments in '08. So I think we're getting a lot of these kind of flashbacks of some of the warning signs, and it's not really shaping up to be one serious cohesive threat yet. But I think we see a lot of signs of maybe potential cockroaches or canaries or whatever animal we're going to call upon right now.
Yeah, and you didn't mention rebalancing of trade flows as well. So what is happening between US and China? I just read earlier today in the FT the interview with the Prime Minister of Singapore, which was fascinating, and he was referring to trade flows as arteries that are being clogged right now, and was arguing for unclogging some of them and potentially creating new arteries. And that's another significant dynamic that is flowing through the global economy, where you could see how things are becoming more inefficient, more expensive, and then it flows through prices, and then you get inflation, and then you get a little bit the whole interest rate regime becomes much more difficult for central banks to navigate. And then ultimately, it will be really difficult in this unstable environment for businesses to continue on the healthier spell that they have had for the last few years.
Well, fascinating. You moved to trade. A great segue there. In equity markets, clearly markets aren't that comfortable with extreme trade movements. I think we've normalized a certain amount of tariff news, and we still don't quite know who's absorbing the tariffs. But certainly the extreme tariff rhetoric last weekend and did weigh on markets then on Friday, and then even still this week. This is just so far this week. Going back to Monday, we can see a pretty sideways US market here, reflecting, I think, still some lack of just a lack of certainty around tariffs. The other two factors that I think just as asset allocators, we think about obviously the concentration that continues. We continue to see the S&P outperform an equal weight. Whether that's something that is, I think even the individual investors now are starting to worry about this. I think it's 44%, the top 10 stocks now in the S&P. And then the other factor, this is just one out of two markets outside the S&P, the UK's FTSE and the South Korean's Kospi, just as an example as to just how well some non-US markets have done this year. FTSE has held water relative to the S&P, but I think another perhaps vote in favor of global diversification when we think about how a portfolio should look. Any thoughts yourselves as to whether anything different it should be done around equity market diversification at this point? Any overlooked areas you think we're not thinking about?
Yeah, well, we don't quite know about tariffs, but we have more clarity than we had in April is quite telling, because it just shows how much uncertainty there is in the system, and hence how wide the outcomes could potentially be. I would argue that many were surprised with the reaction of the business to tariffs, that the expectations of the retreat were much higher than what actually happened in the last how many months since Liberation Day. But then there is this element of front loading, where actually many businesses were trying to place orders at the old prices before tariffs kick in, and some of the capital expenditure projects that were just like accelerated to a degree to get the benefit of the previous regime. But it is, I probably would say, just about now where actually the impact of tariffs and how they affect cash flows is starting to kick in. And despite that, you still have the S&P growing strongly and breaking the records, because there is, of course, the whole AI and technology and then fiscal stimulus, one big beautiful bill in the US. So it's just so complex that it is hard for any investor to disintegrate those factors and see how they're like, what will be the impacts of the confluence of them. But the first word on the headline in your slide, concentration, is actually really important for investors. So almost pretty much every portfolio will be too concentrated in the US, in the US dollar. And so looking for ways to diversify is really important geographically, but also by the type of assets that you get exposure yeah, and get your risk factors in.
Of course, as well as the dollar. And we didn't put something in the dollar that this week just because it's been featuring every week, but it has obviously diversifying by currency is key. Just another few trends in markets to comment on. It is amusing that we're still seeing this meme stock appearing out of nowhere. This case, Beyond Meat. Something going up by more than 450%. Clearly, there's a lot of speculative money on the sidelines or just risk seeking. The interest in meme stocks is high. Another interesting point is that having been high for some time, the MOVE index, the fixed income volatility index, is still quite low. That may be back to that kind of comfort level around the direction of rates. But we do see the VIX, the equity market volatility index, spiking and higher than it has been certainly since the beginning of the year. So I think there's something to watch that certainly would reflect what we're seeing in the markets. Love to maybe move to geopolitics now. You've already touched on one of the headlines I had here about the sanctions on Rosneft and Lukoil, and that has, as you mentioned, had an immediate effect on the oil price. I think what will be interesting is to see just how long and sustained these geopolitical effects are. They seem to have been quite short-lived. And just to go back, where are we now? Well, it's discussion around China, whether the economy is in a good state and a bad state. I think it's safe to say that it's less dependent on the US than it would have been. And we last week I showed some slides around soybeans. There's a lot of chatter around the Argentinian bailout and whether it's justified and whether it'll make a difference, essentially, given the elections are pending there. And then the final thing on, not the final, but another aspect of the geopolitics we're seeing is that we've had this ongoing negativity around France and lack of confidence in the politics there. And there seems to be a little bit of pressure that easing there, given there's been a letting up on pension reform, or at least not trying to make reform. So I suppose there's a lot of issues. You mentioned a confluence of issues, and we've got wars that seem to be, for now, in a peace process. We've wars that are still raging. We have governments falling, and as you mentioned, the arteries being rerouted around trade. What's your sense on geopolitics and its effect on markets, its potential to affect markets, as well as anything that you think we're not giving sufficient thoughts to?
Yeah, well, it has always been a factor, but now it has become one of the top, if not the top factors that is likely to have an impact on institutional investors' portfolios, on asset pricing. We run annual surveys of institutional investors around the world, 700, and we test for which risks are at the top of the mind, and macroeconomy, energy transition, even inflation was overtaken by geopolitical risk in this year's survey. One of the issues there is that institutional investors are probably not quite used to be bringing geopolitics strongly into investment decisions, and hence the toolkits. How do you actually assess geopolitics, especially when it is so volatile that every morning you wake up and there is another piece of news that could potentially have significant impact on pricing. But I would argue that it's actually something that investors, asset allocators need to find their comfort with, find ways to tap into the expertise and the sources there, and think about how frameworks that they apply to their portfolios, because it is, especially when the situation is so uncertain and volatile, you really need to exercise a certain level of agility in your thinking about allocations to various asset classes, to various strategies, and just thinking through the impact on geopolitics on pricing around the world is actually can help you on top of, as we discussed, geographical diversification and asset class diversification.
It's really interesting, and I'm just going to bring this to a close in a minute, but I do think that this is compared. This was a tail risk that was asked not of institutional allocators, but of fund managers, and it's interesting for them. Geopolitics was 6% in terms of their allocation. AI bubble was at the top there. They're also concerned about inflation, dollar debasement. That's a big theme we even hear from individuals. given they are generally their wealth is expressed in dollars in my case. And then trade wars triggering a global recession had seemed to have eased. It's interesting just to compare to some of the findings that you had there from your institutions.
Yeah, definitely. And you have a much more tactical, so I can see that it is monthly. And I'm pleased to see inflation showing up quite consistently there. The weighting is fairly high. The interesting about AI equity bubble, I think similar to other factors there, it's sort of like so multi-layered there. Uh, the thinking about, are we in the bubble or are we not? But there is definitely an increasing concern about the level of spending on AI technologies, and then in turn on energy required to support this AI boom. And at the moment, it has been really positive for the economy and for the growth, because you invest and you get all the cash flows from suppliers who build data centers and build new energy. But then at some point, it will have to flow through capex and actually find some new cash flows. The productivity increases there. And at the moment, no one really knows. So it may emerge, and there are clear use cases that are flowing through certain industries and some companies, but it may potentially not provide the productivity miracle that the current levels of investment seem to be justifying. And so from this perspective, it's sort of, you cannot really bet on one or another, but you can be pretty certain that there will be a level of disruption one way or another. And this is where resilience of portfolios, diversification becomes really important.
Absolutely. Well, the final talk just finally just mention, we don't have to go into detail just on gold and Bitcoin. Clearly, a bit of a sheen coming off gold this week with this down 6%. Silver having a similar sell-off, but both up very substantially still from the beginning of the year. It seems there's been a bit more digging around what has been driving this increase in the gold price, because it was confounding commentators that the markets were going so well and we had strong economic growth and such a strong demand for gold. It seems there's been a bit more of an understanding now that this has been very a lot of Chinese buying, a lot of technical buying there, with Chinese holdings of gold increasing and their holdings of US treasuries decreasing. And then we can also see that gold and ETF flows, gold and Bitcoin flows sort of operating sometimes in reverse, sometimes in sync, not a pattern that we can fully really extrapolate for anything from yet. But I think it has been just fascinating to see just this rush into gold as it has risen up. Well, thank you so much, Luba. This has been a wonderfully rich discussion where you spoke about the orthogonal thinking that you bring to everything that you do. And I think already in this whistle stop tour of many of the macro topics, you brought some orthogonal and food for thought to every single one of them. So thank you for coming here and sharing your insights with us.
It's always a pleasure to speak with you, Ethan. Thank you so much for this interesting conversation.